The market is currently closed, and the last reported closing price for Rezolve AI PLC, traded under the ticker RZLV on the Nasdaq, was $2.93 on Thursday, December 4, 2025 at 4 p.m. EST. This figure represents an interesting dynamic given the recent dramatic fluctuations in the stock price that have characterized this name, particularly the heavy selling pressure we've seen in the wake of the recent acquisition news. The immediate surprise that stands out is not the price itself, which sits near the middle of its recent range, but the fact that a company operating at the intersection of high-growth AI and e-commerce, two of the hottest investment narratives in the market right now, continues to struggle with persistent price volatility and an inability to sustain upward momentum. Investors are clearly captivated by the AI commerce story, yet the reality in the trading pit is one of deep skepticism about the execution and the company's capital structure, forcing a difficult but necessary conversation about the gap between narrative and financial mechanics. The general market expectation for RZLV, especially among retail investors who are active in this small-cap, high-growth sector, is that the company is a pure play on the integration of large language models, or LLMs, into the trillion-dollar e-commerce space. The belief is that their proprietary Brain Commerce platform and Brain POA LLM are going to provide a substantial edge in conversion rates and customer personalization, which is the holy grail for online retail. This narrative, which has been vigorously promoted and widely discussed across platforms like Reddit and X, paints RZLV as an overlooked gem that will inevitably catch up to its much larger AI peers. However, the contrarian, and frankly more grounded take, is that the price action suggests the market is fixated not on the size of the opportunity, but on the cost of capturing it. The recent price movement, particularly the dip following the announcement of the acquisition of digital experience platform CrownPeak, signals that the market views this growth not as organic scaling, but as growth being bought at a price potentially too high, involving significant dilution or capital risk for a company that is currently unprofitable and has negative shareholder equity. Analyzing the recent stock movement, we have to look past the intraday noise and focus on the significant swings. In the last year, RZLV has traded in a massive range, from a low of $1.07 to a high of $8.45. This immense volatility is a clear indicator of a speculative stock rather than a mature, fundamentally driven enterprise. The stock was a scorcher in September and October 2025, riding the general AI enthusiasm wave, but those gains have been aggressively clawed back. The daily trading volume has been consistently high, often hovering around the 15 to 20 million share mark, which is substantial for a stock with a relatively small market capitalization. And this high volume facilitates quick price discovery and reflects intense institutional and retail jostling. Specifically, the reaction to the CrownPeak acquisition news in early December was telling. Despite the strategic value of expanding their commerce platform, the stock fell sharply, losing over 10% on one of the announcement days. This points to a clear market concern over the financing of the deal. The capital structure risk is outweighing the business expansion reward in the eyes of many large institutional players. The market is effectively demanding proof of accretive value, not just a promise of increased scale. The recent price movement, particularly the lack of a clear sustained bottom post-acquisition news, signals that the uncertainty around future capital raises or debt restructuring will continue to pressure the price in the short term. The stock has been trading with high weekly volatility, which, while appealing to day traders, is a red flag for long-term holders seeking stability. To properly understand the tension here, we must briefly touch on what Rezolve AI PLC actually does. The company is a United Kingdom-based entity specializing in artificial intelligence-driven commerce solutions. Their core product suite is designed to enhance customer engagement and revenue growth for the retail and e-commerce sectors. Their platform provides AI-powered solutions for personalized search, frictionless checkout, and omni-channel engagement, positioning them as a critical infrastructure layer for modern online and mobile commerce. Their proprietary LLM, branded as BrainPoa, is the engine that attempts to replace traditional keyword search with more intelligent conversational commerce interactions, aiming to improve key metrics like conversion rates and average order value. The business model is a cloud-based software as a service (SaaS) subscription model, often with usage-based components, generating revenue globally with a significant portion coming from the United States. While revenue has shown impressive year-over-year growth, the company is still significantly unprofitable, posting large net losses and carrying negative shareholder equity, which is the fundamental financial reality that counters the optimistic AI narrative. Past performance has been erratic, with the stock price heavily correlating with positive press releases, particularly those related to strategic partnerships or acquisitions, rather than consistent quarterly profitability improvements. Now, let's pivot to the crucial element of short seller awareness and what it means for RZLV. This stock is undeniably under significant short seller pressure, and this pressure is a major driver of the high volatility and resistance to upward price movement. The latest available short interest data is a significant piece of the puzzle. We're looking at a short interest of approximately 12 million shares, which represents over 10% of the public float. A short interest percentage of float in the double digits is a signal that a substantial portion of the market believes the stock is overvalued and is actively betting on a decline. The short borrow fee rate, which is now below 3%, reflects the sufficient supply of shares available to borrow, which helps to keep the short selling machine well-oiled. Actionable steps for investors here include monitoring the next NASDAQ bi-monthly short interest report to see if the total number of shorted shares is still increasing. Moreover, always check the off-exchange short volume ratio, which for RZLV has been reported as high as over 42% on certain days, indicating a substantial amount of short activity happening away from the public exchanges, a point of constant debate and suspicion among retail traders who call for greater transparency. You have to remember that a high short interest is not inherently a sign of manipulation. It's often a sign of sophisticated investors finding a compelling case for overvaluation. Looking ahead, the future outlook for RZLV is a mix of high-stakes catalysts and considerable risks, all framed by that core expectation versus reality dynamic. The expectation is a smooth, rapid ascent to an annual recurring revenue of $500 million, a target the company has publicly set for 2026. The reality is that achieving this requires flawless integration of recent acquisitions like Crown Peak and Subsquid, and a significant acceleration in new customer wins and upselling existing customers, all while navigating a high interest rate environment that penalizes unprofitable growth companies. The major catalysts to monitor are any future strategic partnership announcements with major global retailers, which would lend credibility to the platform, and crucially, the next earnings report. That report must show a clear, measurable reduction in net loss and a believable trajectory toward cash flow positivity, or the market will punish the stock mercilessly. From a technical perspective, the stock needs to hold the $2.50 support level. A break below that could signal a further capitulation and a return to the 52-week lows. The risks are straightforward: ongoing shareholder dilution to fund operations and acquisitions, and competitive pressure from larger cash-rich tech giants like Amazon and Microsoft, who are also focused on AI-powered commerce solutions. The ultimate opportunity here is for RZLV to become a critical, independent middleware layer for e-commerce, but that vision requires substantial financial backing and clinical execution. The retail sentiment, especially the discussion on forums, is deeply divided. On one side, You have the believers, who see the low stock price as a fundamental mispricing driven by temporary short attacks and fear. On the other, you have more cautious participants, pointing to the high price-to-sales ratio and the mounting losses as evidence that the company is a classic story stock, whose valuation has run far ahead of its fundamentals. This polarization is exactly what drives the erratic price action. We need to be vigilant about the difference between a coordinated short attack and legitimate fundamental short selling. The former is rare and often involves spreading misinformation. The latter is just a calculated bet against the company's financial stability. The best defensive strategy for the long-term investor is to ignore the squeeze hype and focus on the fundamentals. Is the revenue growth rate sustainable? Is the burn rate manageable? And does management have a credible path to profitability that doesn't rely solely on frequent share issuance? So do you think Fuzzy Panda Research or other notable